Welcome. We are broadcasting for the first time on YouTube. We're very excited about this and the opportunity that we have to kind of get get our videos out to a larger audience, and that's kind of the idea about launching our YouTube channel. Um, Along with me, I have my colleague Austin. Austin, hello. How are you doing?
Doing great. Excited to get started.
Great. So if you guys don't aren't familiar with our company name is Capital Financial Planners, which is home of the RETFED, which is our federal employee retirement training program. We train federal employees. That's really kind of been our niche for the last decade. And today's presentation is really a special presentation that we've put together um, because we've been getting fielding a lot of questions from clients, prospects, those folks coming in on their one-on-one sessions about just investing in a year that is supposedly more volatile because it is an election year, right? And election year cycles tend to generate more fear. We're going to talk about that, but real quickly, before we move on to our content here, I just want to kind of give you some understanding on the functions. One function is our chat function. So our chat function works where you can list down questions, comments. We'll be able to see those, but we're going to field those after the presentation's done, simply so the recording of this will be streamlined, and then we'll do those Q&A at the end. Number two is you're going to see on the screen is a QR code. That QR code is going to be for a registration for a one-on-one meeting. If you're interested in doing that, very easy to do. Take out your mobile phone at any time, scan that QR code, you'll get a registration page. At the end, we'll also be sharing that QR code as well as the website registration link for that as well. So that's just kind of the housekeeping. Let's go to some introductions, Austin. So I'll just introduce myself. My name's Neil Kane. I am a CFP. I also am a chartered federal employee benefits consultant. I've been in the industry for actually over 18 years. We've got to update this slide. Working with federal employees pretty much solely besides 2 of those years. I'm local to the DC area, grew up in Rockville, Maryland, attended Towson, finished up at Georgetown. My colleague here, Austin, with me, certified financial planner as well, 6 years of experience in the industry, two specializing in federal employees. So that's a little bit about us. Most of you probably know that. Let's get into just the volatility or fear or perceived volatility that we think we're going to have because it's an election year. Well, so far, it's been anything from that, right? The market has been lifting up to new highs. The S&P 500 is being propelled mainly by those 7 companies that are in the Magnificent Seven. If you've tuned into previous videos of ours, you would get an understanding of that. But at what point during this year are we going to start to see the volatility? Are we going to start to see that fear spike? Well, it's still to be determined. And that's what we're going to be talking about today. Is there a moment or is there a time in the year where we should see a major retraction of the markets because markets start to get a little ahead of themselves, or markets just don't like uncertainty in terms of who's going to be the next president, right? So that's what we're going to be talking about today. And the history is really what we're going to be diving into. So, Austin, if we talk about essentially the illusion of control, right, versus reality, one of the things that comes up is when we start to kind of formulate a plot or a storyline of how things are going to go, we start getting very confident with that mindset, right? We start thinking, well, for sure, we've got a pretty contested election coming up. It's going to get pretty heated. Markets should respond probably negatively to that uncertainty, right? We start to formulate that plot, and then we get overconfident with that storyline. We almost can guarantee the thought that that is going to happen when that's actually pretty far from true. And what we think is going to happen is that fear, that uncertainty, right, is going to work out where markets start to shake down. And then what ends up happening is we ourselves get in that state of uncertainty and fearful, and we aim to try to protect ourselves. So we end up doing something instead of looking at our portfolios from a long term perspective. We get short sighted. We start to make adjustments that are really short term. I actually had a client talk to me yesterday about should I, move things out and maybe start to get things back in the summer. That's that fear, that uncertainty that's coming really from what we call a election year, right? So what we're going to do is do a deep dive. Austin's going to help us with the history and data. Austin, take us away. Tell us what you see in terms of history. What does it look like? Should we be scared? What are we thinking here?
Sure. So yeah, personally, I'm a bit of a data nerd. I like to look back and see what's happened in history, and I think the easiest way to calm some of those fears that we have is to look back and see what's actually happened in previous election years. So what we've done here is we've gathered a set of data, and what that data has told us, there's four main themes that we really have seen and that we'll explore as we're going through this. And the themes are that one, US stocks have trended up regardless of which party wins the election. Okay, Republican, Democrat, doesn't matter. US stocks have trended up regardless. Primary season tends to be volatile, but stocks tend to bounce back afterwards. Okay. Investors tend to get nervous. People tend to move more cash move their money into cash leading up to an election year and into an election year. And the culmination of this is that staying on the sidelines throughout the election, pulling into cash and waiting it out has not wound up being the best result. And we'll look at the reasons why. Okay. So let's look at some data here. First, election years versus non-election years. Okay, this has nothing to do with party or anything like that. This is just how is the market done in election years versus years when it's not an election year. And this is comparing a 60-40 portfolio. Okay, 60% stock, 40% bond. So mostly in the market, mostly in the S&P 500, 40% in the bond portfolio. And something that's honestly shocking to most people is that presidential election years have wound up doing 1% better on average than a non-election year. Okay, there have been 41 election years, 122 non-election years since the 1860s. Okay, and we've actually averaged a better return during election years. The other thing that people always get concerned about is, okay, maybe we average better, but it's got to be more volatile, right? It's got to at least be, my money's got to be a roller coaster ride during this election year because we don't know what's going to happen. Honestly, when we look at a couple of truly volatile markets, okay, we look at 2008 financial crisis, the 2000 .com bubble, even COVID, okay, and we see these gray lines here, and we look at the volatility ratings during those years. And then we look at this grouping of election years, that these are the ones that are all highlighted in this green turquoise color, not nearly as volatile as some of these truly volatile years. And if you look at the timing right around the election, things almost go flat, right? There's a little bit more volatility here in the beginning of the year, and we'll talk about that here in a second, why that is. But surrounding the election, not nearly as volatile as some of these, truly shaky years.
Very surprising there.
So another thing that comes up frequently, and we're all probably guilty of this to an extent, is typically the news source we're watching is fairly biased one way or the other, right? Most of them are. And something that you'll come to believe when watching these news sources is that, well, if the other party wins, whichever that other party is, surely the economy, the market is bound to do worse, right? Surely, if the party that I'm not in takes over, the economy is gonna tank and we're not going to see any gains. Well, history would tell us that that's just false. Okay, regardless of which presidential party or which political party has taken the president, the market has averaged positive returns no matter what. And over this time from the 1930s, right? If you would have just invested $1,000 in the S&P 500 at the beginning and held it for this 100-year period, okay, you'd have $19 million. There's been 8 Democratic presidents, 7 Republican presidents over that time, and it hasn't mattered. Okay, the market's averaged up regardless. And the crazy thing is, I mean, we can look at this from a breakdown perspective, and you can see even further, not just who's presidential control, but the House and the Senate.
Now
Okay,
be careful, Austin, of getting too political here. Okay,
and we're not going to get too
we
political.
don't want to ruffle any feathers, but let's see it.
Yeah, we're
Let's see it.
that's not the goal to ruffle any feathers here. And actually, the interesting thing that we see here is because the market is so sensitive to unknowns, okay, the most sensitive to things changing, the way that change happens quickest is when one party is in control of the president and Congress, right? And so what we'll see here is the two top performing periods are when there's a split between who the president is and who's the majority in Congress, and even a split within Congress between the House and the Senate. And that's frankly because when the least amount happens. When the least amount happens, there's going to be the least polarizing things happening. That's going to make the market happy because change is the unknown.
So the market likes status quo is what you're saying.
The market likes status quo.
Yep.
Yep. So, a lot of people right now are asking the question, well, sure, this is great for all these previous times, but it feels like right now the buzzword for the last 4 years has been unprecedented times, right? We're in unprecedented times.
Yeah, but
this is unlike anything we've ever seen before, right, Neil?
But Austin, these are unprecedented times, right? So should we factor in this year differently? Of course, we have really kind of a more polarizing election, I think, with two candidates that are going to be a pretty contested battle there. But let's take a look at just in terms of haven't we been in unprecedented times throughout history? I mean, well, number one, if you guys are looking at a fairly small screen, you can expand this, just FYI. Hope you are. Or if you're looking on your mobile device, it's going to be small. But what you're looking at here is basically a history going back essentially the last 50 plus years of market performance in history, shown this is over a 10% return since 1970. And we're going through some pretty darn unprecedented times in all of those scenarios. I mean, the 70s weren't just a smooth ride in terms of economy. Neither were the 80s, but as you can see here, some pretty significant gains during all of those events, right? So these are reasons why we shouldn't think that just because this year we have a lot of geopolitical risks, we have still inflation that is starting to tame down, and it's getting down to where the Fed wants to see that. There could be a spike up, so we don't know that, right? But we have higher interest rates. We have still a pretty good economy, but we have some risks in the system. Sure, we do. But we really always have. So that's not necessarily an excuse to say, well, these are unprecedented times. Let's invest our portfolio differently. You really have to have that long-term outlook on the stuff in your portfolio that should be long-term, right? And folks really tend to go with what they're hearing, right? It's the herding bias, right? I'm not going to spend a ton of time on this slide, but we all get that when A bunch of people are doing one thing. A lot of people kind of jump into that bus with them and follow them. And in fact, investing is quite the opposite. Sometimes you want to be what's called a contrarian. You want to do the opposite of what that herd's doing. Okay. Generally speaking, when it comes to an investment world, that's a pretty good way to make some money in the markets, is doing the opposite. Now, you don't want to get too cute with that strategy, but you don't want to just jump in on one particular bias and run with that. Diversification is what we preach.
And
Austin?
I think we took this slide out of the presentation, but Warren Buffett has the famous quote, right? Be fearful when others are greedy, and be greedy when others are fearful.
That's true.
And that's the contrarian approach we want to take, right? When others are greedy, we can be pretty sure the other shoe's going to drop eventually.
For sure.
But when others are fearful, that can be a great time to actually invest, because what happens when others are fearful is the market might move sideways, move down, when none of the fundamentals that make it a great place to invest have actually changed. And so what actually happens during an investment year or an election year? Our election year is actually more volatile than non-election years. We've already looked at average returns, and we know average returns are about the same, actually a little higher for election years. But what about volatility? Are they shakier? Here's something that really surprised me. Okay, if we look at the average non-election year here in dark blue on the top, you can see that, yeah, there's, over time, if we're gonna make this average, it kind of just gradually eases up, right? Finishes higher than we started. During election years, something interesting happens, and this speaks to the market's, again, distaste unknown. During election years, typically the market essentially moves sideways, not up, not really down, until the primaries are figured out. Okay? At primary time, the market kind of finally figures out what direction it's going to go, and it finishes the year up stronger, from the summer going forward, than a normal year. An election day here really does nothing to impact that movement. And to put numbers to that, so since 1932 here, if in the 12 months following the conclusion of the primaries, okay, so once the primaries are wrapped up, election years average 11.3% return over that next 12 months, compared to a normal year where it's 5.8%. Now, you could say this year is a little bit different because the primary appears to be about sorted. And that could be a reason that we haven't seen the market really have much volatility this year. I mean, where people are acting like this is just any type of normal year with a good economy. And this is part of the reason why. Okay. Uncertainty, again, that's the big point here, is the market's worst enemy in this scenario. Now, another thing that's really interesting here is looking what the average investor does between their cash and their investments leading up into these election years. Okay. When you look at the year going into an election and then the year it happens, look what happens to money market funds. Okay. These are the cash funds that investors hold. Okay. Money market funds see a dramatic increase in inflows heading into election years because people are anticipating this volatility that ultimately history shows us doesn't happen. And they're sitting on the sidelines throughout the election cycle. And then once the election happens, they're pouring all their money back into equities. And look what happens to the money market fund. Okay, it's chopped in a third or a quarter of where it was before the election cycle. And so anybody who kind of knows how the market works, and wouldn't you rather be in the market before all this money flows into the market rather than wait until after it's all flowed in? to
Yeah.
wait and invest.
Yeah.
That's
People are protecting themselves right there, it looks like. And then after they realize, hey, I don't need to do that anymore. That's when the drop off in money market goes into the market. It looks like.
yeah, it's pretty interesting. And Capital Group actually did a study on this. So again, they looked back from 1932 till now, and they ran three hypothetical investor profiles essentially. Okay, so someone who took their, and this is showing someone who has $10,000 at the beginning of an election year. Okay, and they looked at three different profiles. One, the first person invested their $10,000 on January 1st, and they held it for the full 4 year presidential term until the next election year. Okay, that $10,000 was held all the way through. The second person said, "Well, I know that I should be invested, but I don't really feel comfortable investing it all up front. I feel like there's going to be some volatility. I don't know. So I'm going to get invested, but I'm going to do it in increments. I'll invest $1,000 a month from January to October until my $10,000 is invested." The third investor here decided they didn't want to risk it, and they were going to sit on the sidelines and just be out of the market. They were going to take their $10,000, hold that until the end of the election year, wait till everything's sorted, and then invest at that point and stay invested for the next 3 years. Okay. When we look at how that played out, that first investor that put everything in on January 1st and stayed invested through the whole time had the best outcome 14 out of the 22 cycles. Okay. The vast majority had the best outcome. They also averaged with the highest ending balance. Okay, the second investor here that kind of dollar cost averaged, they did a monthly investment of $1,000. It was the second best scenario. They wound up with the best outcome 5 out of the 22 times, and actually wound up pretty close in terms of final value to that first investor. Sitting on the sidelines almost never paid off. All right.
Wow.
Holding your money in cash over the election season, investing afterwards was the best outcome 3 times, but it was the worst outcome 16 times. Okay. And they wound up with substantially less money. So,
Yeah. Pretty
you know,
pretty interesting.
yeah, looking back at the last 100 years of investments or elections, it's looking like keeping your money in has been the way to go. So, what makes that so hard for us, Neil? Why do we have such a hard
It's,
time doing this?
it's that old mammalian brain of ours. That people call it the monkey brain, the flight or fight brain. We look at our money as if we're getting into a fist fight with someone, and we're nervous about that. So sometimes we just run, and that's exactly what part of the brain money stimulates. It stimulates that old kind of side that keeps us safe, right? But as we kind of look forward and we start to look at just the emotional decisions that come from tapping into that side of our brain, generally that is wrong advice, right? Your brain's giving you wrong advice. And think about that just in general terms. How many times has your brain been wrong about what it's told you? Okay? That little voice in your head isn't always right. You don't want to listen to it all the time because a lot of times it's going to get you into trouble, especially when it comes in investing. What you're seeing basically is a depiction of that. When things are going good, the average investor wants to put their money in. They see everybody else making money. When things start to retreat and go down, that investor typically can't take that pain anymore, gets out, and then generally speaking is going to get out at the wrong time and then put that money finally back in at some point in that recovery, but really lose money in that scenario. So you just don't want to be this person if you really can avoid it. Okay, because if we look at just putting your money in over long periods of time, sticking to your guns, right? Not letting that short term volatility force a bad decision, the likelihood of positive returns in the market over time start to get to essentially 100%. Okay. Now, you might be saying, well, Neil, I don't got 20 years. I'm about to retire in 2 years. And listen, I get that. But not all your money is needed in the first couple years of your retirement. There's got to be a portion of your money that's for the 10 years and beyond in retirement, right? And that's going to be your long term bucket. We don't really have a slide to talk about what we call the bucket strategy, but the bucket strategy is really about thinking of your money in different buckets or different stages of your life. And really, what you're going to use in the next 1 to 3 or 1 to 5 years should be in that short term bucket. That should be safe. But beyond that, that's where we get to the mid and long term buckets that really need to be invested for those long term type of goals or expenses. And that's where the market really comes in. And that's where you need to be invested in that long term bucket. And that essentially starts to get better results over time as you leave that stuff alone. Now, if you start playing around with your investment account, you start trying to time the markets, right? This is where big mistakes happen. So, markets generally will retreat, and then generally right after that, they'll have really strong recovery days, okay? And they're very close together. So, you might find last week the market went down 1,000 points, right? Strung together there really closely will probably be a 1,000 point up day. If you chose to get out on that down day and miss that up day, it's a really detrimental thing to your retirement account over time. Take a look at the chart. Missing the 5 best days of the market going back 20 years from '01 to 2020 would have given you half the value of what you would have made had you just left it in, which is in orange there, that orange bar. Missing 15 days would give you about a third of the value that you would have made. And then missing 25 days essentially gives you a negative return over that 20-year period. So that's 25 days of up days, strong up days. Missing those give you a negative return. Now think about that for a second, right? Can you afford to do that with your retirement savings? Can you literally grow nothing on your retirement savings because you were sitting meddling around with it, missing some of those best days and actually taking on some of those worst days? No, you can't. So the strategy is really to put yourself in a diversified approach, leave that stuff alone, let it grow, and especially let that long-term stuff grow. So the side of our brains that really starts to think in that format is going to be that logical part of your brain, right? That prefrontal cortex. Okay, that's the side of your brain that brings in logic. Hey, I shouldn't touch this stuff. This stuff is not going to be needed for XYZ years. I'm going to take the pain right now and just let this stuff grow out and do what it needs to do. So we encourage you to use that mindset. And so does Warren Buffett, right? He basically says, we don't got to be the smartest folks in the building when it comes to investing. We don't know how to pick tops. We don't got to pick bottoms, buying and selling. We just have to be disciplined. So what does that discipline mean? That means staying diversified. That means just staying invested. And that means stop trying to guess and time the market's ups and downs.
Yep. I mean, I can't, and I'm sure Neil, you can relate to this as well. I don't know if I can count how many times I've met with someone who is wondering when to shift their money from the C fund to the G fund because things were just too volatile for them, right? And we see that a lot, meeting with federal employees, wanting to shift things around within the TSP. And, the whole takeaway here is that is extremely difficult to do. And doing that risks hundreds of thousands of dollars over your lifetime. So, our takeaways here are, first and foremost, I know there's a lot of fear surrounding election years, but ultimately they have very little impact on the markets. Um, and honestly, that fear in people holding out gives you an opportunity as an investor to benefit from them holding out and then pouring their money back in afterwards. We've seen that markets have been more volatile during primary season, but we also have seen that they rise stronger than an average year after that. We've seen case studies on people who sit out of the market during election years tend to lose, right? And people that stay in tend to win. Um, and even people who decided to, hey, make monthly investments, stay regimented about their investment strategy, keep throwing money into the TSP, they're also going to do better than money or better than people who stayed in cash. So those are our key takeaways. Now, as you've seen, this is our first webinar on YouTube, right? This is what we're going to be doing from here on out. We're going to be on YouTube. This gives more people a chance to hear what we have to say, to watch these videos. It also makes it a lot easier for you guys who are wanting to watch these after the fact, right? You can just log into YouTube. You don't have to go to our site, log in, things like that, and you can see these here. So we always get questions on where the slide's going to be afterwards. They'll be on YouTube, right? You can go through, check on this, watch it anytime you want. If you joined late, all you have to do is back it up, and you can watch it from the beginning or watch it any other time, right? So what we would ask, so you can stay on top of what we're posting here, is subscribe to our page. Okay, when you subscribe here, you're going to get notifications whenever we do anything. So we'll not only are we going to be doing these monthly market commentaries here, but we're really ramping up our efforts to share more information with you and have more free education on this page. So if you not
Yeah.
only are interested in these monthly market commentaries, but you also want to hear us talk about, Roth conversion strategies and estate planning and charitable giving and all the different things that we have information on.
So, Social Security, Medicare, federal benefits, tax planning, all sorts of stuff that is going to be posted on a periodic basis on this channel. It's not going to be a live event every time, right? The market commentaries like we're having today are going to be live events once a month, but we are going to be pumping in other videos on other kind of more financial planning and tax planning, state planning, those topics as just normal videos. And the only way you're going to be able to get that right is if you're subscribed to the channel. And we ask you to like the video that you're on right now because it allows that algorithm in YouTube to start building. That's obviously what we're trying to accomplish here because we're starting from scratch. So all you guys that are on this today can really help that initiative and move our channel forward a little bit so we're not just hidden from everybody in the YouTube catacombs.
Exactly. Yeah. So now that we've asked that favor from you, we'll give you something in return, right? Um, like what Neil alluded to at the beginning of this, if you were watching this presentation and you're thinking, "Oh shoot, I moved everything to G Fund at the beginning of the year because I was nervous about this. Like, what the heck do I do now?" If you've got questions on using the traditional or Roth side of your TSP, Social Security, any of those specific questions that you have that we just can't answer in a format like this because they're specific to you, we offer a free call to anyone who's on this webinar. If you haven't done one before, or if it's been a long time since you have, we call it the financial checkup. It's complimentary. And the way to sign up for that is you go right here, retfed.com/register, or you can scan this QR code and it'll take you right there. It'll be a
Yep.
one-on-one call with either, me, Neil, or one of our other advisors or coaches. And it'll be exclusive to your situation. So really helpful to answer those more unique questions to your situation.
Yep. Yep. And to add on to that, it's typically a Zoom call or a Zoom meeting,
Yep.
FYI. So if you have Zoom, that's how we do those, and we set them up for an hour. All right. We
Should we
got
open it
anything
up
else,
for questions?
Austin?
No, I don't have anything else. I think we could open it up for some questions. So if you guys have um, questions on anything that we went through today, there is a chat feature. So feel free to type those questions in the chat. We'll see them on our side, and uh, we'll answer those as we go through. I haven't seen any come through yet, so don't be shy.
Okay. Well, I don't see any. So, again, thank you for joining us for our first YouTube session. This was great. I think it was a success. We've put in some time and effort just to the layout that you're seeing, and look forward to hosting you guys and giving you a lot more content coming through our channel in the future as we start to ramp up our YouTube. So, again, thank you for joining, Austin. I think it's time to sign off here, my friend.
All right. Yep. Thanks,
All right.
everybody. Hope you have a great week.